What is the smartest way to invest your first $100 online? Not the fantasy answer. Not the turn it into a Lamborghini by Friday answer. The real answer. Because 4 years ago, I put this question to the test. I took $100 and spread it across different beginner-friendly investments you can buy from a laptop. Today, we're looking at what actually happened. And one result is exciting. One is painful. And one is so boring. It may be the best choice of all. Pause for a second. If boring makes more money than hype, why do most beginners still chase hype? Let's talk about it. The biggest mistake new investors make is not starting too late. It's starting confused. You open your phone, type "best investment for beginners," and suddenly the internet starts screaming at you. Buy crypto, buy gold, buy real estate, buy dividend stocks, buy this one hot company before it explodes. Everyone sounds rich. Everyone sounds certain. And almost nobody talks about what happens after the excitement fades. That is where beginners get trapped. Because investing with $100 is not just about making money. It is about learning what kind of risk you can handle, what kind of growth you actually need, and what you can stick with when the market stops being fun. And trust me, the market always stops being fun for a while. A green chart can make you feel like a genius. A red chart can make you question your whole bloodline. So instead of asking, what can turn $100 into the most money the fastest? The better question is, what can a beginner understand, survive, and keep doing for years? That is the question that matters. Because the truth is simple, your first $100 is not supposed to change your life overnight. It is supposed to change your behavior. It is supposed to teach you how money grows, how risk feels, and how patience gets rewarded. And that matters more than one lucky win. Here's the funny part. Most beginners want a perfect answer, but investing does not reward perfect. It rewards consistent. So let's break this down in the cleanest way possible. 3 categories, 3 mindsets, 3 different paths your money can take. And by the end, you'll know which one makes the most sense for most people starting small. Let's start with the flashy stuff. This is the path that gets the most clicks, the most headlines, and the most late-night "should I buy now" messages. I'm talking about individual stocks and crypto. These two are very different on paper, but they create the same emotional effect. They make beginners feel like they are one smart move away from a breakthrough. And sometimes that feeling is not totally wrong. Let's start with individual stocks. Buying a stock means owning a small piece of one company. That sounds simple, but doing it well is not simple at all. If you want to pick winning stocks, you need to understand the business, the leadership, the money coming in, the debt, the competition, and whether the company is still growing or just good at looking impressive online. In other words, it is not guessing. It is homework. And that is the first problem for beginners. The learning curve is high. Sure, buying a stock takes 10 seconds. Understanding what you bought can take 10 weeks. That is a huge difference. Now here is what makes individual stocks attractive. The upside can be amazing. If you pick the right company and hold it long enough, your money can grow fast. Some stocks also pay dividends, which means they can send you cash while you still own them. Sounds great, right? Yes. Until you pick the wrong company. That is the problem. In the 4-year comparison, the random stock pick ended up being Samsung, and the $100 position fell to roughly $67.72 total after including dividends. That is a loss of about 32.3%. Ouch. Same market, same time period, totally different result. That is the danger of stock picking. A few winners can look incredible, but one weak choice can drag the whole thing down. If your dart lands on Apple, Microsoft, or Nvidia, you feel brilliant. If it lands somewhere weaker, welcome to humility. The market has a very expensive sense of humor. Now let's talk about crypto. Crypto is where logic and chaos rent an apartment together. On one side, you have a real idea: digital assets, blockchain systems, decentralized networks, limited supply. On the other side, you have wild price swings, hype cycles, scams, panic selling, and people acting like a coin with a dog on it will replace global finance by next Tuesday. That is why crypto is so tempting. The upside feels massive. In the same 4-year comparison, $100 in Bitcoin grew to about $652. That is the kind of number that makes people lean forward. That is the kind of result that creates FOMO. And that is exactly why beginners get in trouble. Because when people see that kind of return, they stop seeing risk. But crypto is extremely volatile. It can move like a rocket one month and like a trapdoor the next. It also pays no natural income the way rent or dividends can. Yes, there are ways people try to earn yield, but those usually come with extra risk, extra complexity, or both. And taxes? Usually not your friend. So here is the truth about the exciting path. It can absolutely make the most money. It can also destroy your peace. If you enjoy research, can handle huge swings, and know how to manage risk, this lane can have a place in your strategy. But for a beginner with just $100, this path teaches one brutal lesson very fast. High reward usually comes attached to high stress. And not everyone wants their first investment to feel like a hostage negotiation. Now let's move to the calmer side of the room. This is where gold and REITs live. These investments do not usually make people feel like geniuses at dinner parties. Nobody slams their drink on the table and yells, "Guys, wait till you hear about my steady and reasonable asset allocation." But these options exist for an important reason. They are not built to thrill you. They are built to stabilize you. Let's start with gold. Gold has one big advantage. People trust it when they stop trusting everything else. That is why it has survived for so long. Through inflation, panic, currency weakness, and economic fear, gold tends to hold a special place in investors' minds. It is the old-school bodyguard of wealth. The learning curve here is low. You can buy physical gold, or you can use a gold fund and avoid dealing with storage. It is simple, easy to understand, easy to explain. But there is a catch. Gold does not produce income, no dividends, no rent, no cash flow. It just sits there and tries to preserve value. That can still be useful. In the 4-year test, the $100 gold investment grew to around $140.10, a return of about 40.1%. That is solid, not explosive. Solid. Gold is not the asset you buy because you want fireworks. It is the asset you buy because you do not trust fireworks. Now let's talk about REITs. A REIT is basically a way to invest in real estate without buying a whole building, dealing with tenants, fixing sinks, or receiving a 2 a.m. message that says, "The bathroom ceiling is leaking." That alone deserves respect. REITs collect money from many investors, use it to own income-producing real estate, and often pay out a big part of the profits as dividends. That makes them attractive for passive income. And for beginners, they are much easier than owning a property directly. No giant deposit, no mortgage, no paperwork mountain. You can buy in with a small amount and still get exposure to real estate. In the 4-year comparison, the REIT position itself slightly dipped in price, but dividends pushed the total result into profit to around $110.52 overall. That is a modest gain. Not exciting, but real. And that is the whole point. Gold and REITs represent a different mindset. They ask a different question. Not, How fast can this grow? But how well can this hold up? That matters because many beginners think good investing means maximum speed. It does not. Good investing also means surviving hard periods, managing emotion, and not needing to panic every time the economy sneezes. Defensive assets will not always win the race, but sometimes they help you stay in the race. And staying in the race beats quitting. Now we get to the option that rarely sounds sexy, rarely goes viral, and very often ends up being the smartest move for most people. Index funds. This is where investing stops trying to be dramatic and starts trying to work. An index fund lets you buy a piece of many companies at once. Instead of betting everything on one stock, you spread your money across a whole market or a big section of it. That means one weak company hurts you less because you are not depending on one hero to save your portfolio. And this is where the beginner advantage appears. Because beginners usually do not lose by being too simple. They lose by being too clever too early. Index funds have a low learning curve. You do not need to read 5 balance sheets before breakfast. You do not need to guess which CEO will dominate the next decade. You do not need to panic over every earnings report. You buy the market, you hold it. You let time do the heavy lifting. That is it. Boring? Yes. Effective? Also, yes. In the 4-year comparison, $100 in an S&P 500 index fund grew to about $179.54. That is around a 79.5% return. Now think about that for a second. It beat gold. It beat the REIT. It crushed the random stock pick. And yes, it lost to Bitcoin. But without the same level of chaos. That matters. Because investing is not just about the highest return in a perfect example. It is about the best balance between growth, simplicity, risk, and consistency. And index funds are very strong in that balance. They may also come with good tax advantages if you use the right kind of account in your country. And over long periods, that matters more than beginners think. Keeping more of what you earn is not boring. It is powerful. Here is the real beauty of index funds. They make patience easier. When you own one stock, every piece of bad news feels personal. When you own the market, you think bigger, longer, calmer. And that is why so many experienced investors end up sounding like broken records. Not because they lack imagination, but because they have seen what usually works. Simple, regular, long-term. The truth is, most people do not need a genius strategy. They need a strategy they will actually follow. And index funds are exactly that. So what is the best way for a beginner to start investing online with just $100? Here is the answer. Start with the option that gives you the best mix of clarity, survival, and long-term growth. For most people, that is an index fund first. Not because it is the most exciting, because it is the most repeatable. If you start with index funds, you learn the habit of investing without making every day feel like a test of your intelligence. You build exposure to real businesses. You lower your chance of one bad pick ruining your confidence, and you give yourself room to grow your knowledge over time. Then, if you want, you can add small side positions later. Maybe a little gold for stability, maybe a REIT for income exposure, maybe a tiny amount of crypto if you understand the risk and can emotionally afford the volatility. Maybe a few individual stocks once you know how to evaluate businesses. But the core? For most beginners, the core should be simple. Here is a practical way to think about it. If your goal is learning without too much stress, start with index funds. If your goal is protecting value, look at gold. If your goal is income, REITs can play a role. If your goal is maximum upside and you accept maximum risk, then stocks and crypto belong in small doses, not as your entire plan. That is the difference between investing and gambling. Investing asks, how do I build? Gambling asks, How do I hit? One creates a future, the other creates a story. And yes, sometimes the story sounds better, but a quiet future full of growing assets is still the better deal. Also, let's say something that beginners need to hear more often. Your first investment does not need to be perfect. It needs to begin. Because once you start, you stop being the person who only watches money moves from the sidelines. You become the person learning the game in real time. That shift is huge. $100 is small enough to start. It is also big enough to teach you. And those lessons compound too. So let's wrap it up fast. Individual stocks can be powerful, but they take work, and one bad pick can hurt. Crypto can explode upward, but it is highly volatile and emotionally expensive. Gold is steady and simple, but it does not produce income. REITs give you real estate exposure and income potential without buying property yourself. Index funds are not flashy, but they are diversified, beginner-friendly, and in this comparison, they delivered one of the strongest all-around outcomes. So the real winner is not the asset that looks coolest in a screenshot. It is the one you can understand, hold, and keep buying for years. That is how small money starts acting like big money. If you want to build wealth without making it complicated, subscribe to Sandra Mindset. And tell me in the comments, if you had only $100 to invest today, would you choose the boring winner or chase the big upside?